If the stock market dropped 40% next year, would you know it was coming? Not the headlines after it happens, not the experts explaining it later. I mean before the panic, before the layoffs, before everyone suddenly starts Googling, is this a recession? Because here's the uncomfortable truth most investors don't want to hear. The biggest market risks never look dangerous while they're forming. They look exciting. They look innovative. They look like the future. And right now, the market is showing the exact same signals it showed before one of the most famous crashes in modern history. If you care about your savings, your retirement, or even just the money sitting in your index funds, you need to understand what's happening. Because this isn't just about Wall Street, it's about what happens to your portfolio next. Before we go further, if you want simple breakdowns of how money, markets, and the economy really work without the Wall Street jargon, make sure you subscribe now so you don't miss what's coming next. All right, let's get into it. My name's Andrew, and today I want to walk you through something that feels strangely familiar. Let's rewind for a second. Imagine it's the late 1990s. The internet is exploding. Every week there's a new company promising to change the world. Investors are convinced this is the greatest opportunity of their lifetime. Stock prices climb, news anchors talk about a new economy. Regular people start quitting jobs to trade stocks full-time. So you invest. And for a while, it works. Your money keeps going up. Everyone feels like a genius. Until suddenly, it doesn't. When the dot-com bubble burst, the Nasdaq lost almost 80% of its value. Thousands of companies vanished. Fortunes disappeared almost overnight. And the crazy part? The internet really did change the world. The technology itself was real. The profits eventually came, but the hype arrived first, and the market collapsed long before the future finished arriving. So why does this matter today? Because fast forward to now, and the same kind of energy is back. Only this time, the magic word isn't internet. It's AI. Everywhere you look, companies are racing to dominate artificial intelligence. Investors are calling it the next industrial revolution. Some say it will reshape every industry on Earth. And maybe they're right. But history has a dangerous habit. It doesn't repeat exactly, but it rhymes. And that raises the real question. Are we witnessing the birth of the next economic supercycle or the early stages of another massive bubble? To understand that, we need to look at three powerful forces quietly shaping the market right now. The first force is concentration. Today, the direction of the entire U.S. stock market is heavily influenced by just 7 companies: Apple, Microsoft, Amazon, Alphabet, Meta, Tesla, and Nvidia. Together, they make up an enormous share of the S&P 500. That means even if you think you're safely diversified in a broad index fund, a huge chunk of your investment is effectively riding on the performance of these tech giants. And right now, every one of them is locked in an arms race over AI. They're pouring hundreds of billions of dollars into data centers, specialized chips, cloud infrastructure, and research labs. Not millions, not tens of millions, hundreds of billions. The kind of spending normally associated with national governments. Why spend that much? Because whoever controls the dominant AI platforms could control the next generation of software, search, commerce, productivity tools, and advertising. It's not just about building better chatbots, it's about owning the backbone of future business. But here's where things get complicated. This massive spending spree is also propping up huge parts of the current economy. Construction firms building data centers, energy companies supplying power, chip manufacturers ramping production. Entire supply chains are now tied to this AI expansion. Which leads to the uncomfortable question: what happens if the expected profits don't show up fast enough? And that brings us to the third force, what some analysts call the AI money loop. At first glance, everything looks normal. Chip companies sell processors, cloud providers rent computing power, AI startups build models, big tech funds research. But when you trace the money more closely, you start noticing something interesting. Major tech firms invest billions into AI companies. Those AI companies then spend huge portions of that funding buying cloud services and hardware from the very same tech giants. Those giants then use the revenue to purchase more chips and infrastructure, sometimes even reinvesting back into the same AI ecosystem. In other words, large amounts of capital are circulating inside the same network of companies. Now, to be clear, this doesn't mean anything illegal is happening. These are real services, real contracts, real products. But it does mean reported revenues across the sector are heavily interconnected. Growth in one area often depends on spending from another part of the same system. And that creates a fragile situation. Because ultimately, someone outside that loop has to generate sustainable profits. Businesses, consumers, advertisers, governments. Eventually, the real economy has to justify all that investment. Right now, many AI services are wildly popular, but still expensive to run and not consistently profitable at scale. Which brings us to the third force, the limits of progress. AI has improved incredibly fast over the past few years. Faster image generation, better voice tools, smarter assistants, more capable automation. Investors have come to expect this rapid acceleration to continue indefinitely. But some researchers warn that future improvements may become harder and more expensive. Training advanced models already requires enormous computing power, enormous energy consumption, and vast quantities of high-quality data. Each new leap forward could cost dramatically more than the last. If progress slows, even temporarily, expectations built into current stock prices might suddenly look overly optimistic, and markets don't handle broken expectations very well. Now, here's the important part. Does this mean AI is fake? Absolutely not. Just like the internet, the technology itself is transformative. AI will almost certainly reshape industries, eliminate some jobs, create new ones, and unlock entirely new business models. The real risk isn't that AI fails. The risk is that investors expect the financial rewards to arrive faster than reality allows. That gap between expectation and timing is exactly what creates bubbles. So, what should ordinary investors actually do with this information? First, don't panic and don't try to time the market. History shows that consistently investing through both booms and crashes beats jumping in and out based on headlines. Second, make sure you're not dangerously concentrated in a single sector, no matter how exciting it seems. Diversification isn't boring, it's survival. Third, focus on the one factor you actually control, your income and savings rate. The more consistently you invest over time, the less any single market cycle can destroy your long-term progress. Because here's the truth most people only learn after their first crash. Market downturns don't permanently destroy disciplined investors. Panic does. The people who quietly keep investing during uncertainty are usually the ones who benefit the most when stability returns. So, whether this AI boom becomes the greatest economic expansion of the century or another painful correction on the road to that future, the winning strategy for most people doesn't change as much as the headlines suggest. Stay consistent, stay diversified, stay patient. If you made it this far, you're already ahead of most investors who react emotionally instead of thinking long-term. If you want more clear, no-nonsense explanations about money, markets, and the hidden forces shaping your financial future, make sure you subscribe so you don't miss the next video. And until next time, this is Andrew, reminding you that understanding the system is the first step to making it work for you.